biggest investment strategies you'll ever hear. You'll hear it on the media. You'll hear it from financial planners, financial books, brokers. Everywhere you go, you're going to hear this strategy. And the strategy is called diversification. So before we get into it, I want to tell you what Warren Buffett says about that. He says diversification is protection against ignorance. Another thing he said is it makes very little sense for those who know what they're doing.
Diversification, you're right. That was, that quote by Warren Buffett, there's a lot to be said on this. Overwhelming dogma of the markets is, hey, invest for the long term in a well-diversified portfolio and hang on. And the first thing I was, and there's a lot of people that believe in that, titans in the industry. One of the people I read a lot and really listen to a lot that believed in diversification completely. Here's what I find interesting about diversification. If I'm going to have someone else do this for me, and I'm going to pay someone else to do this for me, there should be some advantage, or one would hope there would be some advantage over what I could do myself. It is essential in my view, or advisable in my view, to look at the other side of the coin. Well, what do I get for diversification? Well, I get my money spread around, basically, and that's what I get. And it's going to be what it's going to be, and it's indexed to the market, and I don't have a lot of control over that. I'll tell you who it's great for. If you look at the other side of the coin, and you listen to that dogma, put yourself in that great big building on Wall Street, in that big fancy office. And everyone's sitting there saying, well, how do we get assets under management? How do we make money? Well, it's very simple. The more money we take stewardship of, the more money we have that we can charge fees for doing this diversification. This is awesome because if we just diversify and say we're going to mimic the market, when the market falls, it's not our fault.
Right.
So keep your money in, and we're going to keep earning cash off of performance that has really no nothing about it, right? Absolutely no insight, creativity, work, even really not much work.
Right.
So it is certainly the idea to diversify and hold on for a person's whole life and just keep putting your 401k money every 2 weeks into their coffers. There's no question it's a benefit to them. I mean, it is a no-brainer. It's no risk for them. It's an infinite return for them because they have no money in the deal. The investor takes all the risk. Bogle talks about compounding costs, and his argument was nothing wrong with diversification, but you shouldn't charge a lot for it. So he would say if you have a fund that is not diversified and is supposed to be done with skill, and you charge these exorbitant fees, 2%, 2.5%, 1.5%. He says, no, come to my Vanguard fund at, 50 basis points and we'll diversify you, but we won't charge you as much because we're not doing as much. But, more to my liking is I study both men. I love both men. I respect and learn from both men. Benjamin Graham, Warren Buffett's a mentor, talks about his book, The Intelligent Investor. And that book is really about two things. Number one, it's about temperament and how you approach it emotionally. And number two, it's a little bit about method. And what Benjamin Graham says, he says, very few people get excited about putting in the time to A, learn securities analysis, and B, do it. Now, doing it is not as tough as it used to be in Benjamin Graham's day because now you have computers. I mean, Buffett in his office, if you watch the HBO documentary, he's got these big ledgers of, financials information that used to look this thick as a phone book, and Buffett just looks at those with nostalgia. He says, I remember, reading through these and picking.
Right.
So there was a time element to really grind through and say, what is it? Let's talk about that method for a minute. One of the things Warren Buffett has argued is he said, let's say there were 100 companies. There's actually thousands. But let's say there were 100 and you have enough money to buy 10. Well, if you diversify and just diversify throughout that 100, picking 10 diversified, you're just acknowledging that you're going to pick up some stuff that is losing. that you're going to be buying less than the best you could try to buy, less than the best you could. Now, people always want a guarantee because they have jobs and they want that guaranteed paycheck. That doesn't mean Warren Buffett picks the best. It just means that he believes in doing his best to do so. Let me say it again. It doesn't mean Warren Buffett picks the best. Every year, there are companies that grow more than Berkshire Hathaway and more than companies Berkshire Hathaway owns. But he says, why would you not want to do the very, very best you could do? You know, think of it as picking a basketball team from the local high school. Maybe I just diversify. I get tall people, short people, you know, fat people, skinny people, men, women, you know, all different races. I'll do all this. Well, does a great basketball team look very diversified when you watch the NBA?
Not so much.
You got guys that are 6'7", you know, not guys that are 5'1", very rarely. You know, you have athletes, you have a certain body type, right? They're not diversified at all. Why? Because you want the best and you want to win. You're just going to do what's going to win. And so as you go to pick from the colleges, you're looking at statistics, you're doing analysis, you're watching film, you're seeing what their attitude is, what they represent, what they stand for. Are they a good kid? Are you going to wind up with, you know, a Len Bias situation, right? You want to find all these things out so you can pick the best team you can. That's called fundamental analysis. It's the first pillar of investing. Is when I tell my son, let's go find something, we have criteria. That does not guarantee that we've picked a winner. Things change in the market all the time. It does not guarantee. But you know what? I feel better inside saying, hey, the problem is when people try to predict the market, it's really not what it's not what Buffett's going to do. He's not looking at the stock price, predicting the stock price goes up. He's saying, look, this is a company that seems to have some pretty good products. And their numbers are telling me that people seem to buy these products. Their brand seems really, really strong. You know, these guys got a moat around them. They got some protection. Their financial statement is in such a way that it seems like they have some financial strength and they might last for a while. He thinks that is a better way to avoid tragedy than just buying everything.